Longer-term interest rates have been on a tear recently, with the 10-year Treasury rate increasing from the March 2020 pandemic low of only 54 basis points to a 2021 high of nearly 1.8%, with most of that advance coming this year. Over the past few weeks, however, that advance has stalled out, leading investors to ask why. As we think about the drivers that have calmed down the bond market here and kept rates relatively steady after such a dramatic climb, it really breaks down to a few key and related factors. First, inflation expectations have come off the boil here as more investors are looking through what we all agree will be a near-term uptick in inflation over the next several months. Real rates, or the interest rate adjusted for inflation, have stabilized and in fact have fallen a bit this month, really driven by a stabilization in the outlook for price increases. Now, if we look at market price expectations as reflected in the 5-year inflation break-even rate, we see that this rate has certainly been elevated over the past several months and currently sits at just over 2.5%. It's really stabilized, though, since mid-March. Interestingly, the 10-year break-even rate has also stabilized and sits at 2.3%, so below the shorter-term 5-year rate. Again, this reflects that investors are forecasting the expected jump in inflation to be transitory. Now, key to this inflation outlook is the commodity complex, and here we've also seen a change in view. If we consider WTI, the U.S. crude benchmark, we see prices falling over 10% from a high of $65 back in mid-March. Now, there's a strong correlation between inflation expectations and commodity prices, so this decline doubtless contributed to a more stable inflation outlook. So, consistent with our forecast, we've seen rates hit a bit of a ceiling here, and as a result, we've seen equity volatility fall. We've also seen growth stocks, widely considered to be fragile in the face of higher interest rates, resume their upward trend. Growth has outperformed value over the past month after lagging significantly over the prior several months. This leaves us asking ourselves, does the bond market finally believe the Fed, and have bond investors come around to the fact that the Fed will leave rates on hold despite some expectedly strong data on both growth and inflation? This appears to be the case, at least over the past few weeks. That said, a key risk remains that the bond market tries to test the Fed's resolve. Well, that's not our base case, which remains that interest rates are going to be low and range-bound well into the future. It is a risk, and it's one that we think the Fed will address if needed.